Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema. With me is Vinny. And for the markets, there has been a remarkable recovery. Once again, the Nifty has taken support just shy of that 22,000 mark. The intraday low today was 21,965. From there has been an over 100-point recovery on the Nifty. The mid-cap index, which is now back in the green, has recovered 1,100 points from the session lows, and the small-cap index is surging. And that's the reason why the advanced decline ratio has now turned firmly in favor of the gainers. When we opened up trade, we had nearly 4 stocks declining for 1 stock advancing. Those lines crisscrossed early on in the first half an hour, 45 minutes of trade. And since then, the gap between the gainers and decliners has only been widening. We've got about 1,800 stocks advancing for 750 stocks currently in the red. Well, it's, defense, PSU banks, which are leading from the front. Those are the sectoral indices which are topping the chart. State Bank of India is your top gainer. BEL is up nearly 2.7%. Oil marketing companies are on a tear with the decline seen in crude prices. On the way down, you've got Bajaj Auto that's shrunk, that's sinking close to about 3%. And then a combination of FMCG, IT stocks are under pressure. But all in all, it's heartening to see the 22,000 mark is holding on as a support, and buying has emerged in the mid and small cap stocks.
It does give you that fear, right? Is it going to go below that mark? Because yesterday also when we were talking to these market guests as well, everyone is fearing where is it going to be headed from here. 22,000 seems like that psychological mark, at least for the markets that everyone's keeping an eye out on. But surely important to watch out for. Some of the names that I want to highlight is also coming in for the broader markets. Mascot Dock, Cochin Shipyard, they're managing to hold on to good gains as well. So that is something to watch out for in terms of a move that we're seeing for the shipbuilder stocks as well. And interesting to watch out for in terms of trends, Reema. But I think, Reema, we have SBI that's in focus today as well. And this is on the back of a Citi note. Abhishek is joining in with us to give us the details of what this note is highlighting for SBI as well. Good morning, Abhishek.
Good morning, Vinny. So, Citi met the management of SBI and they have double upgraded SBI's rating to buy from sell, increased the target price to 830 per share from 720 that they had earlier. The key points that they have mentioned is that there is sharper focus with respect to net interest margin, a sustained growth as well as asset quality, and valuations remain inexpensive. So the key takeaways from the meeting with the management is management has outlined a multiple liability cost optimization yield levers as well as relatively lower EBLR loans, just 28%. MCLR hike should help in protecting the net interest margin downside. Now management has continued to guide net interest margin guidance of more than 3%. However, Citi expects net interest margin to be within 2.9% to 3% over FY25 to 27. The growth visibility is backed by express credit traction, robust corporate pipeline that they have, and accelerated housing loans as well. Unsecured retail slippages have been curtailed at less than 0.5%. The SMA2 pool, which is overdue between 60 to 90 days, that's also been reined in. So they expect the credit cost to be curtailed at less than 50 basis points. So they expect that the restoration of risk weights on NBFCs can boost CET1 ratio anywhere between 25 to 30 basis points. Weak market sentiments ally that the near-term equity raise overhang over there. So they are factoring a 13 to 14% of growth. Curtail credit costs, they revise their earning estimate anywhere between 1% to 2% over the next few fiscals. They say that the stock has corrected and has underperformed Nifty over the last 3 months, 6 months as well as 12 months. So valuations are inexpensive at price to book value of 0.85x 1 year forward, given the fact that ROA of 1% and ROE of 15% augurs well with respect to the valuations comfort that they have on SBI. Back to you.
Okay, Abhishek, thank you so much for that. But let's move on and talk about some of these EMS companies that are in focus today. And today we have a note that's coming from Investec on this front as well. Upasna, what is the note highlighting? What is it that one is watching out for from these EMS players?
Well, certainly, Investec has written a positive note on EMS companies. Now, it has upgraded Kaynes Technology and Syrma SGS to a hold rating from sell earlier following the sharp correction seen in the EMS space that we saw recently, with valuation now looking reasonable is what the brokerage is highlighting. Now, brokerage says that it is convinced about the growth opportunity in the EMS space going forward, but has highlighted few concerns such as low barrier to entry, high working capital intensification, weak cash flow generation. These are some of the factors is what they've highlighted for PCBA companies. Now, it prefers Dixon Technology and Amber Enterprises. It says Dixon's capital efficacy and cost competitiveness and management's opportunistic approach is what stands out as compared to other peer companies. Hence, it prefers Dixon. And when it comes to Amber Enterprises, it says that the consumer durable business of the company is facing some competitive pressures, but electronic and railway business is yielding impressive ROICs and may face compelling growth drivers going forward. Hence, it is bullish on these two stocks.
Thank you very much for that. And let's turn our attention to quick commerce, always in the news, Swiggy and Zomato. There is an ICICI Securities note, so let's find out what it says. Mangalam joins in with more. Mangalam.
Well, there is a note that has come in from ICICI Securities where they've done a bunch of channel checks, and what they've figured out so far is that while discounting still persists in the quick commerce space, maybe at product level the discounts are past the peak that we saw in November and December itself. Instead, what is happening is that, say for instance, I'm looking to buy a soap on quick commerce. Instead of giving me a 30, 40, 50% sort of discount on that soap itself, they're giving cart level discounts, which is basically if you order for say 500 or 600 rupees, you will get a 50 or 100 rupees off. What this does is reduces the discounts on a per product basis, but increases the incentives for people to go ahead and buy higher average order value products, and that in turn is a benefit for quick commerce companies. So yes, discounting persists, but the peak of product level discounts may be behind them, is what channel checks as per ICICI Securities is suggesting. And for those who are looking at investing in these companies, ICICI Securities says valuations now look compelling from a 1 year or more holding period itself, and as a result of which they've reiterated both their buy calls on Swiggy as well as Zomato. On Swiggy, the target price is 740 rupees. For Zomato, the target price is 310 rupees. On the back of this note and the news that companies are deploying newer strategies, reducing performance marketing spends as well, and taking steps that while may increase user engagement, but also at the same time reduce risks to their contribution margins, is positive, and these stocks are bouncing back off the lows.
Okay, Mangalam, thank you so much for that, keeping an eye out on the quick commerce names. But let's move on. And, we spoke to Ramdev Agarwal of Motilal Oswal Financial Services yesterday about his views on quick commerce space. Let's listen into what he had to say about this as well.
That is one sector which is holding out very well. If you see, because see, what is happening is, while price is where it is, I mean, it might have fallen 20-30% from the top, they are increasing value at very rapid pace. Price is here. Okay, it has come down from here, but value is increasing very rapidly. So it is quite possible if it stays here for 3-4 months. See, if you are talking about investing, it's not about picking the absolute bottom prices. It's about buying at fair prices. Okay, are you buying a company which is growing at 50-60% at a fair valuation? My sense is that is one sector where there is a momentum, and momentum will pick up further, and it will become very interesting. There are not some 10-20 players. There are only 2-3 players, and others will find it difficult to enter. Of course, others will try as the pie becomes big. I think it's fair value. It is stabilized in the sense that, see, nobody can say that 5% can move down from here. It can, but we are closer to the bottom, I'm saying.
Okay, on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll come back and we'll be discussing what's buzzing in the world of commodities with Manisha Gupta, so don't go anywhere. Welcome back. Thanks for staying tuned into Trading Hour on CNBC-TV18. Let's move on and shift focus to the commodity space. Manisha is joining in with us, and this time she's highlighting importance in terms of metals, but this time it's not yellow metal, Manisha, it's the red metal.
Well, it is. And, you know, the headline continues to be tariffs and the way the world really seems to be dealing with that uncertainty. So while that is keeping the markets choppy, but within that space as well, you have to take a look at the copper prices because they seem to be standing tall. If you look at the LME markets, we are looking at copper prices trading around $9,900 and the US copper prices clearly trading at a premium with all those tariff conversations. So the US copper is trading at around 2-week highs above 5.5 or thereabouts. Well, we have seen, if you look at the US markets, they're in 50% of what US requires in sense of copper it imports, and much of that comes in from Peru, Canada and Mexico. And with the way the tariffs really seem to be going on, there's a lot of import of copper that we've seen into US. So, and there's an arbitrage opportunity as well, and you have the US copper prices trading at $100 per ton of a premium than what the other markets really seem to be doing. And because US imports much of its copper, it will really have to start its domestic production now. As of now, we understand that even as China may have a dozen smelting copper smelters there, US perhaps have 2. So you will be looking at perhaps an investment therein as well. More interestingly, it is the JP Morgan report that has come in overnight, which says that they are looking at a global copper deficit in 2026 to the tune of 10,000 tons there. Also, they do expect the copper prices to continue to trade higher, not just this year, but the next as well. And they also anticipate higher deficits going forward in the next couple of years or so. Inventory build-up in US and shortage in the rest of the world is another phenomena that the markets really seem to be working with. This is yet again JP Morgan's view coming in sense of global growth. So while we did see 3.2% for 2024, but we are looking at more global growth of around 2.9% in 2025 as well. So that tells you in some sense that the copper prices will continue to be firm. At this point in time, in this year until now, copper has been the best performer within the base metal prices. We are up by nearly 15% in this year already, and more gains is clearly what the street seems to be working with.
Manisha, thank you very much for that important update. Moving on, Prime Minister Narendra Modi inaugurated and visited the Wildlife Rescue Rehabilitation and Conservation Centre Vantara in Gujarat. Vantara is home to more than 2,000 species and over 1.5 lakh rescued, endangered and threatened animals. The Prime Minister explored various facilities at the centre and also closely interacted with various species of animals which have been rehabilitated there. The Prime Minister visited the Wildlife Hospital at Vantara and saw the veterinary facilities which are equipped with MRI, CT scans, ICUs, amongst others. Prime Minister Modi also interacted with doctors, supporting staff and workers who are managing various facilities at the centre.
Okay, and a small program, on that note, actually, we're going to slip into a very short break. Viewers, don't go anywhere because we'll be back with more news and updates after this short break, so don't go anywhere.
Welcome back. Benchmark indices down about 0.25%, but this is after seeing a recovery in the first 1 hour of trade. The Nifty is holding on to the 22,000 mark. Experts have pointed out that 21,800 to 22,000 is an important support for our market. And that's the question, right? Are we close to the bottom? Because we've had a relentless fall over the last couple of weeks. And is the sell-off coming to an end? We posed this question to our market editor yesterday, Ramdev Agrawal of Motilal Oswal Financial Services. And this is what he had to say about the market trajectory going forward.
Earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%. And there is obvious reason for credit slowdown, economic slowdown. Every aspect of tightening by the regulators have happened. And now, and there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. So I think we have set the mood. One, correction is done. The P multiple, which was at 23, 24, that has come down to less than 20. And it is at below 10 years average. So I think it is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. I think the divergence between mid and small is too high. Let's see how the market does. Maybe mid will keep correcting and large will make a move. Or large will make a move, but mid will stay there. And then it will catch up. So market does its own stuff. I think most important thing is now, don't wait for because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Now this is a time, stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay. So if you like certain stock, and that stock is available at your dreamy price and it has gone below that, don't hesitate, start moving into the market. In 2-3 months' time, when promoters will actually come to buy, because they are the guys who are the smartest. They know the value of the company. So when the promoter starts buying, so actually you got seeing that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, you know, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected. Capital market is as, you know, as the sentiments gets hurt in last 5-6 months, there is a decline, there are restrictive, say like from daily F&O, now you have come to weekly expiry. So obviously there is a almost 30-40% decline in the overall F&O volume. So we got expanded too much. Between 21 and 24, we got expanded too much, and then the regulator got scared and they said, we want to contain it. And that's what they did. And effect of that is visible. I mean, Nitin of course knows the books. You know, so that's what is happening in broking. That's what is happening in slowdown in now. AMC flow was very good till last month. This month, I think there is somewhat, it is slower.
Important opinion as always when there is so much pain in the market and investors are confused what you should be doing. Mitesh is now with us for a quick technical check in the market. Mitesh, in the morning you were telling how that recovery spark is missing. Now that we've had a little bit of an intraday pullback and the markets are holding on to this 22,060 odd level, what is the approach on the index and your individual ideas?
Yeah, I think, that still is missing. I was hoping that the bank Nifty will take out 48,400 and we got a higher 48,355. So I think that confirmation on the upside is still something which I am craving for, which we haven't got as yet. So the idea is that, we might want to wait it out for that move to play out. In case we see the bank Nifty capture 48,400, I think that will be the first suggestion that the declining force should be arrested. And then we can look at, Nifty getting to about 22, 150, 200 zone. I think that if that is clear, then I think, we can look at least, if not a trend reversal, at least a stronger bounce back than what we've had for the last few days. So on the index, still waiting and watching, but I do hope that, the way the bank Nifty has reacted in the face of a negative opening and gap down, I think there is a chance that we might see a late afternoon revival. But till then, I think, just sit tight on the indexes.
Okay, so tight on the indices. And Mitesh, anything that you're looking at specifically in terms of stocks, mid cap, small cap or large cap? What are you looking out for right now?
On the stock side, I have a buy on CESC. I think that's something which is reversed well. So buy here with the stop at about 132 for targets of 141 or so. And Dabur is something on the negative side. So sell with the stop at about 491 for targets of 470.
Okay, Mitesh, thanks so much for that. On that note, we're going to slip into a very short break, viewers, but a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This is a prestigious platform celebrating SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code on now and submit your entry for SME Champion Awards Season 2. Welcome back. Thanks for staying tuned to Trading Hour on CNBC-TV18. Let's move on. And in our special segment, Fin Street, Abhishek Toll is here to today tell us about how Q3 FY25 panned out for the housing finance companies and NBFCs. Over to you, Abhishek.
Well, it has been a good quarter for the non-bank lenders with respect to the loan growth and net profit growth. Now, net interest income surprised positively, which actually helped sustain the net interest margin. OPEX cost was very high for both HFCs and NBFCs. Now, earnings have relatively been driven by the lower provisions that you saw this time around. Improvement in asset quality continued for them. Outlook remains healthy. Some pockets are witnessing asset quality issues. So for housing finance companies, the loan growth in Q3 FY25 was about 14.5% YOY and about 3.2% sequentially. X of LIC Housing Finance and Samman Capital, the AUM growth was much healthier at about 27.3% YOY and about 5.5% sequentially. The NII growth was healthy as well. NII growth was around 20.5% on a YOY basis and close to 3% on a sequential basis. So calculation shows that the net interest margin expanded YOY to 4.45%, up about 22 basis point YOY and down by 1 basis point sequentially. Operating expenses were high. They were up more than 32% YOY and about 8.3% quarter on quarter. So operating expenses impacted the operating profits in this quarter. Operating profits were up just 5.7% YOY, but they were down by 2.7% on a sequential basis. Now provisions were at just rupees 60 crores, down about 92% YOY and 98.5% on a sequential basis. So overall, profits after tax for HFCs were up 21% YOY and about 373% sequentially. Now, asset quality continued to improve for them. So, gross NPA value-wise was down about 15% on a sequential basis, while net NPA was down more than 1% on a sequential basis. So, gross NPA ratio as a resultant declined to 1.75% versus 2.1% in the previous quarter. Net NPA ratio also declined by 3 basis points on a sequential basis. So, for NBFCs, X of HFCs, the AUM growth was healthy at about 16.5% YOY and about 3% sequentially. The net interest income growth for them was healthy as well. NII was up 17.7% YOY and 4% quarter on quarter. So calculation shows that the net interest margin actually expanded to 6.6%, up 7 basis points on a year-on-year basis and 6 basis points on a sequential basis. Now operating expenses were high due to employee expenses, which increased sharply. So employee expenses were up 15.1% on a sequential basis and nearly about 26% on a year-on-year basis. So operating profits that grew by 14.7% year on year, but they declined by more than 1% on a sequential basis. Now provisions were at about 8,700 crores, which was up nearly 72% YOY and a decline of 2% quarter on quarter. Overall, profit after tax for NBFCs were up nearly 29% YOY and about 7.35% sequentially. Asset quality improved, but ratio-wise, gross NPA in absolute value was up 0.6% quarter on quarter. Net NPA value-wise was up nearly 3.5% quarter on quarter. As a ratio, gross NPA ratio has declined to 9.77% versus 10% in the previous quarter, while net NPA ratio is at 4.14% versus 4.12% in the previous quarter. Going ahead, loan growth is expected to moderate as per analyst estimate in many segments of NBFCs except gold loans. There are signs of asset quality stress that is emerging in other segments like pockets of vehicle finance, micro loans against property and affordable housing are witnessing pain in asset quality. Pain in the microfinance sector will continue for the lenders. Net interest margin outlook post the rate cut from RBI will be divergent. So rate cut is beneficial for fixed rate NBFCs like MMFSL, Shriram Finance as well as Cholamandalam, while rate cut is negative for floating rate based NBFCs like HFCs, housing finance companies. Valuations are around the long-term averages for superior earnings growth of 15-20% like MMFSL, Shriram, Bajaj Finance as well as Cholamandalam as per analyst.
Thank you very much for that. We will get into a break. On the other side, we'll come back with more on the market. Stay tuned. Welcome back. Will the benchmark indices try and get back into the green? Some stocks are attempting an up move now. IT. So Tech Mahindra is now back in the green. Infosys has managed to trim its losses. Trend is seeing some buying over the last 2-3 days. Yesterday, stock was up 2.5%. It's followed it up with another 2% up move. So these are some stocks in the frontline pack. In the mid-cap end of trade, it's many of these pharma names. So Vijaya Diagnostics is up close to about 12.5%. Wockhardt has moved up nearly 4.5%. IOL Chemicals, pretty decent volumes. IOL Chemicals is up nearly about 5%. And RateGain, which got battered, the stock has slipped 40% plus from its 52-week high. Of that, 30% has come from the beginning of 2025. And RateGain, too, has now moved to the day's high. But let's get you the latest from the insurance sector, because sector regulator IRDAI has warned that health and general insurers against rising commission payouts. Yash is here with the details.
Well, that's correct, Reema. So it's some tough talking which has come from the insurance regulator to the general insurance companies as well as the health insurance companies. What has been the point of concern for the regulator? The regulator clearly seems to be concerned about the fact that insurance companies haven't done, put in their efforts when it comes to reducing or containing the commission payouts which they make to various distributors to sell their policies. And eventually what that has led to is that the cost of insurance products, that is the premium which policyholders pay, haven't really come down because of that particular aspect, that is the insurance companies not reducing or containing the commission payouts. Do remember that about 2 years ago, that was in April 2023, the insurance regulator, what it had done is that it had given some relaxation to insurance companies on commission payouts. It had said that we are removing the limit on the commission that insurance companies can pay to the distributors. Instead, we are putting a limit on expenses of management. Expenses of management has two things, commission payout as well as the operating expenses. According to the regulator, what has panned out in the last 2 years is that the insurance companies have significantly increased the commission payouts, and to balance the limit, to adhere to the limit on expenses of management, they've reduced the operational expenses. So though they are under the limit when it comes to the expenses of management, but the commissions under that, they've increased significantly, and that has led to the cost of insurance products, that is the premium, not coming down and only increasing for policyholders. Now, what is the tough talking which the regulator has done? The insurance regulator IRDAI has told general and health insurance companies that if corrective measures are not taken by them to reduce commissions and also pass on the benefits to policyholders, then in the review which happens in April 2026 of the expenses of management guidelines, it could very well consider the fact of removing the limits on expenses of management and putting that limit back on the commission payouts in individual business segments. What were those limits earlier? About 19.5% for motor insurance, 19.5% of gross premium for health insurance. So, of course, that's the warning which is coming from the regulator, that, contain the commissions, focus on reducing commissions, focus on passing on the benefits to policyholders. Otherwise, we could look at putting the limits back on commissions yet again and removing the limits from expenses of management.
Okay, Yash, thank you so much for that. Just quickly marking Poonawalla FinCorp once, that's also something that we're keeping an eye on. Maharashtra State Tax Officer has initiated inspection of the records at its registered office. The inspection is initiated after the search proceedings issued by the Deputy Commissioner of State Tax. So keep an eye on this one. Right now, Poonawalla FinCorp, 0.6% of what, again, is what it's holding on to. But time for a short break. And after the break, on the other side, we bring you the highlights from our conversation with top pharma players from BioAsia Summit.
Trying to get over it is where today we have a lot of those mental issues that have taken a hold of sport. So many people with mental health issues and so on from sport, because it is the highest risk startup ever that I've ever seen.
I also want to talk about film with you and the James Bond experience.
Yes, the Broccolis were watching me play, and they had tested over several hundred people for the role. They didn't fail. They came up with the right person. They asked if I would do a screen test. And I said to myself, you know what? Who can say they worked at Pinewood Studios in the morning and played at Wimbledon in the afternoon? Everyone has an inbuilt resilience in them, and a determination, a dedication, a discipline, a desire that is burning in there, and we just have to find it. Male, female, young or old, doesn't matter, and you can find it at any time. Muhammad Ali and I were appointed by Kofi Annan when we worked together as messenger of peace for the UN. He said, the service you do for others on earth is the rent you pay for a room in heaven. The commitment from the athlete needs to be total. Forget about your friends, forget about your education, forget about your family, forget about everything that you like in life. And when you're 17 years old, boy or girl, you can't have another girlfriend or boyfriend.
Welcome back. Thanks for staying tuned to Trading Hour on CNBC-TV18. Nifty has recovered from the day's lowest point, but is holding on to the 22,060 levels as of now. Not much of an up move or a down move from that level. Mid and small cap outperformance on that front, as well as the Nifty Bank also is holding on to the green. 48,180 levels around that mark is what the Nifty Bank is holding on to. But yes, on that note, let's move on. And India's emergence as a hub for a global capability center signifies a pivotal shift in the international business landscape, driven by country's technological advancements as well as digital transformation. And life science as well as healthcare is no exception to this growing prominence of GCCs as a part of MNC's strategic growth agenda. I caught up with the top management of pharma sector and players coming in from the pharma industry at BioAsia 2025 Summit. And as we wrap up Trading Hour, listen in to the excerpt of that conversation.
If you just take the last 18 to 20 months, we're now around 2,000 plus employees based out of Hyderabad, trying to get medicines to our patients faster. And if you really go back, fundamentally where we started was very simple. We had a very clear vision and we had a set of core guiding principles. And those core guiding principles were built on how do we build an innovative workforce, how do we collaborate more cross-functionally, how do we get a sense of urgency and a purpose for our employees who can deliver for our patients. And I think that DNA really helped us very well. And if you really think of it, we were also very clear what we didn't want to do, because a lot of the GCCs come in to say they want to do everything. And we held on to that part of what does not fit well as a strategic value for Bristol Myers Squibb Hyderabad. And the other piece I'll add is a lot of people, confuse this to I call it the value versus volume, right? I think we always have to come in for value and deliver to what are the main goals for the company, right? And then value is a broad spectrum. Because in some cases, value can start off with automating and eliminating some simple manual activities. And the other side of the spectrum can be some breakthrough innovation that you can get, right? And we wanted to play to that spectrum, and that was a very clear guiding principle for us. 2-3 things that worked very well for us is we were very open to look at a very diverse workforce coming from different industries. You cannot be innovative by limiting yourself to certain areas or niche skills. So we were open to trying out build a workforce from different backgrounds, different industries, different experiences. And I think it's important to harness that in the first 6 to 12 months, because at some point that kind of fades away. And we were intentional to harness that. And the dream for any leader or any company is if you can do innovation at scale. So we were able to figure that out, mantra for us, that helped us. That led to more people joining us, and that's how we could grow so quickly. So it has to be one integrated culture. It has to be unified so that it's just not innovation happening in pockets only in one place, in one country or in one city. So I think we were very intentional that it would be one BMS culture. We got a lot of empowerment. There's a lot of trust that came in very quickly, and the teams could build that. That is kudos to the teamwork that happened on the ground. I think those 3-4 ingredients really helped us move very fast and deliver value for our capability center in Hyderabad. And just happy that we can sit here and talk about it, and behind it is a lot of teamwork and collaboration and many people and partners coming together.
John, you've been here for a while, but last 4 years, that's something that changed for you all, right? I know. What was it that changed? What was it in the environment and the ecosystem that changed for you all?
Yeah, thank you very much for the opportunity. Yes, you're right. So Novo Nordisk has existed as a GCC here in India for 17 years. But it originally started as a transactional shared service center. And then we kind of scaled slowly. But over the last 4 years, we've grown by just more than 2,000 employees. So today we are 4,500 employees in India, covering pretty much the whole pharmaceutical value chain as a GCC. Everything from research and early development through to all the R&D activities, through to IT, finance, commercial, supply chain, etc. And I think the things that have really impacted this growth, first of all, is our ability to build and maintain trust with our headquarters. So first thing, of course, is to be able to deliver what you promise and not over-promise and under-deliver. So deliver on our promises, deliver quality, deliver efficiency, deliver speed. Second thing is to really maintain trust with our stakeholders. You know, as a broad organization, we have many stakeholders in headquarters, and them understanding what we do and trusting us to put more activities in our case in Bangalore is super important.
Absolutely. You know, Puneet, coming to you, I'm going to pick up from what Mohit as well as John have been mentioning. Value, trust, I think these are the key words, as well as culture. You know, your thoughts on these three as well. How have you built it at Takeda? How has that driven your force going forward for the GCC?
Yeah, it's a great question. And firstly, thank you very much for this opportunity. Value, the entire value ecosystem, right, is so central to Takeda, right? We any initiative, any thought process that we start, starts with keeping patient at the center, right? So we have a value system that talks about patients, trust, reputation, and then business, right? So we believe that if we take care of our patients, we can build trust, we have the right, things that can lead to reputation build-up, business will come automatically. That has been a fantastic approach by Takeda over, 243 years. It's a 243-year-old Japanese multinational, which has been focusing very, very strongly on these PTRB principles and our core values, which is keeping integrity at the center and, talking about honesty, fairness, and perseverance. I think these value and the ecosystem have really helped us, look at India as a strategic location, and we call it as the heart of digital innovation for Takeda, right? So, we went about looking at, obviously a lot of other countries where, we can get talent, right? And John was talking about it. We also ran about, getting talent from other European countries, right? So we looked at what are those strategic locations where we can find talent and not transactional, resources who can just work on, in silos and things like that. That's why our GCC, we are calling it as innovation capability centers, right? And they are all around the world. So starting from, we have from Mexico, Bratislava, India, and now we are going to have ICCs in Japan and so on and so forth. So from a strategy standpoint, our resources, our people are core to us, right? And we want them to get embedded into the business rather than, at one place or the another. It doesn't matter to us. What matters is that our people are imbibing our culture. They are loved and loved stands for living our values every day, right? So they are loved. They love and they are loved, living our values every day, and they get integrated into the business, driving value for the business.
Absolutely, that's interesting. Funny coming to you. You're born and brought up company in India, right? 40 years is what you were saying. Yes. So I want to understand from your thought process, right? GCC, ICC, different names. But for Dr. Reddy's, what has the focus been? And how has that moved for them?
Yeah, so I think you're right. We are born in India for the world in that sense and been around for 40 years now. So for us, GCC has not been like a new idea that came in. It's about how we have structured ourselves to deliver value globally. So beyond the cost arbitrage, it has always been that value arbitrage that obviously started, because cost was not really the concern to start with in the first place, right? So when we looked at the global capabilities, as I would call it, it basically fell into three different buckets. One is, how does it deliver efficiency at scale? So as you're expanding into markets outside India, you're expanding globally into different therapy areas and spaces. How do you create efficiency at scale? So that was one of the key levers as we started looking at global capabilities. The second one is primarily on differentiated capabilities, because as John was mentioning it, some of us were talking about it. It's the only place where you can actually build these differentiated capabilities at scale. And I was talking about how we could build very quickly a lot of omni-channel marketing capabilities right out of India once COVID, hit us, and when we started thinking about some of these things. How do you deliver, digital patient support, patient engagement platforms, build them from here, for instance. And even if you get closer into the core of R&D, deep science research and things like that, there are opportunities which we could actually leverage to, India for and kind of build those right out of Hyderabad in many of these places. So while we take a look at the work globally, like for example, a lot of our peptide work happens out of Cambridge, but a lot of the further elements of the value chain get done out of India. So in a sense that a bit of efficiency, differentiated capabilities, and increasingly as we see when we go into these differentiated business models, as we go into consumer healthcare, specialty products, biosimilars, a lot of these capabilities again, need to be thought more globally. So, for instance, the recent acquisition of an RT brand from Helion, for instance, the business is spread in 30 countries. But then, how do you kind of create the operational capabilities and the model that gets built for the globe, but from India, right?